Hello everyone and welcome back to the Deep Dive. I hope you are fueled up and ready for an intense look under the hood of a company that is, well, currently riding the biggest technological wave since the advent of the personal computer. Today we are breaking down Micron Technology, ticker MU. They are the essential supplier of the world's digital memory, the very fabric of computing. And right now, they are benefiting immensely from the explosion of generative AI, specifically through their leadership in high bandwidth memory, or HBM. But here's the central, intriguing question that every long-term investor must confront. Micron operates in a historically brutal, hypercyclical industry. It's defined by massive price swings and, frankly, capital destruction. The stock has been assigned this massive AI premium, which implies that something has structurally changed. So the question is, are the fundamentals of the memory industry structurally different this time thanks to this new oligopoly structure and the AI demand? Or are we simply riding another cycle that will eventually reassert its painful history and, crash the valuation? We're here to investigate if the AI wave has truly transformed what was a capital-intensive commodity business into a resilient, high-quality compounder.
That is the multi-trillion-dollar question, isn't it? For decades, memory was just defined by capital destruction and self-inflicted wounds. The entire investment thesis today hinges on whether the consolidation into what people call the big three. When you combine that with the just insatiable demand characteristics of AI, does that change the long-term profitability profile away from the historical boom and bust pattern?
Absolutely. And as we tackle these complex, high-stakes questions, knowing where to execute on these investing ideas is crucial. For those who want a professional-grade platform, having the right tools, it really makes all the difference. We use Interactive Brokers because they offer global access, low costs, and the kind of professional analytical tools we need for a deep analysis like this. We've partnered with them to get our viewers a stock bonus when they sign up through our link.
So you get a stock bonus to start building your portfolio, and you support the channel at the same time. That link is prominently placed right there in the description below this deep dive.
That's how we keep the lights on and the deep dives flowing. And of course, if you find value in this kind of in-depth discussion and, high-quality analysis, the best way to let us know and ensure you get the next one is to subscribe and like the video. It truly helps the channel grow. And if you have any questions regarding this company or the memory industry, we want to hear your perspective in the comments section below.
Perfect. Now let's set the stage by laying the foundational groundwork. We'll start with pillar number 1, the business and its competitive fortress. Before we can even touch valuation, we need to understand exactly how Micron generates its profits, and more importantly, how defensible that mechanism is against the global competition.
Okay, let's unpack this business model. When we talk about Micron, we're really talking about the basic physics of modern computing. They are the physical memory of the digital world. The core revenue streams are split into two major product categories, but the investment story, right now, it sits heavily on one of them.
And that split is very important to visualize. You're looking at approximately 70 to 75% of total revenue coming from DRAM. That's dynamic random access memory.
Okay, so DRAM. Think of that as the computer's short-term memory.
Exactly. It's the high-speed workspace for a processor. It's volatile, so the data vanishes when the power is cut, but it provides the immediate speed and bandwidth needed for PCs, for enterprise servers, phones, and especially AI accelerators to execute complex tasks in, milliseconds.
Right. So if your processor is the brain, the DRAM is sort of the short-term memory or maybe the desk space where the brain does its immediate work.
Perfect analogy. And then you have the remaining chunk, roughly 25 to 30%, which is NAND flash.
And NAND is the opposite. That's the long-term permanent storage.
That's right. This is where data is retained even without power. So these are your solid-state drives, your SSDs, which have replaced the old spinning hard drives, and all the flash storage in your phone and your camera.
Both are obviously critical parts of the digital infrastructure, but the margins and, I guess, the strategic importance differ wildly between the two.
Wildly. DRAM, particularly the cutting-edge stuff like HBM and DDR5, that is the high-margin, high-speed driver that everyone is focused on today. NAND, while it's necessary, has historically been a much more fragmented and often a brutal pricing environment.
So what's crucial here, then, is the structural endurance of this business model. The concept is simple. You make chips, you sell chips. But the operational complexity, it's almost unimaginable. We're talking precision manufacturing at the nanometer scale in these massive multi-billion-dollar clean rooms.
Right. But the necessity of Micron's role is nearly guaranteed for the next 2 decades. And this is really the simplest part of the bull case. Compute fundamentally cannot exist without memory.
It just can't.
You can't run a CPU, a GPU, or any specialized accelerator without DRAM. The relationship is symbiotic. It's foundational. We're not talking about a discretionary purchase here. We are talking about an indispensable building block of the entire global digital economy.
So that structural endurance, it provides this bedrock of stability, even if the profitability, swings all over the place.
And the structural trend is not merely linear growth, it's an exponential compounding effect, what we're calling the AI multiplier.
This is a really key point. Historically, growth came from simply selling more devices, a new phone, a new PC.
Correct. But today, the key growth vector is the compound increase in memory per device.
So it's not just more phones, it's more memory in each phone.
That's a fundamental distinction. A standard enterprise server might require, say, 512 gigabytes of high-end DRAM. An AI server housing 8 high-performance GPUs requires orders of magnitude more, potentially multiple terabytes. And it doesn't just need more, it needs a special kind of memory, high bandwidth memory or HBM.
So as the world transitions toward this AI-centric existence with bigger models and more complex inference, the hunger for high bandwidth, power-efficient memory just compounds dramatically.
It's a step function change. We're moving from single-digit gigabyte requirements per computing unit to terabyte requirements. The scale is just staggering.
Okay, so this inherent demand gives the company a license to operate. But what protects it from competition? For decades, the memory industry was defined by a phrase I love, insanity to rationality.
That phrase perfectly encapsulates the last 30 years of memory investing. It really does. In the 1990s, we had over 20 major DRAM players worldwide.
20.
Just think about that. It was an economic recipe for constant, devastating price wars. As soon as demand ticked up, everyone would rush to build capacity,
Leading to a massive oversupply.
a massive glut. Prices would crash, and it would just lead to the subsequent destruction of shareholder capital. It was a vicious, vicious cycle that wiped out all but the most resilient or, government-subsidized players.
And today, after all that bloodshed, we are left with this rationalized big three, Samsung, SK Hynix, and Micron. This consolidation is the first, and you could argue the most critical element of their economic moat.
The barrier to entry here is absolutely insurmountable, and it's all due to sheer capital requirements. We're not talking about starting a software company in your garage.
Not at all.
We are talking about building a single cutting-edge fabrication facility, or a fab. The cost to bring a new fab online today, one that's capable of running the latest technical nodes, is in the range of $15 to $20 billion.
15 to 20 billion.
For one factory.
For one, that expense acts as the ultimate deterrent. No startup, no emerging economy company, unless it's backed by the limitless balance sheet of a major sovereign government, can reasonably enter this market at a scale that challenges the existing three.
It's just not feasible. They'd need a decade of continuous investment in operational learning just to catch up, a timeline that's way too long for any conventional VC or private equity fund.
And this consolidation connects directly to a really powerful mental model, the capital cycle. The decades of, frankly, poor capital discipline finally forced this market structure to become, ironically, rationalized. The result is the rise of what we call the Nash equilibrium. Let's elaborate on that equilibrium, because this is the key structural change that supports the whole bull case. The idea is the industry now understands that it's mutually destructive for any of the three dominant players to just aggressively flood the market with new, unnecessary supply.
Exactly. Historically, if the price of DRAM went from, say, $3 to $4, everyone would rush to increase capacity by 10%. Now, if Samsung, for example, aggressively overbuilds to steal market share from Micron, they crash the global price point. And in doing so, they hurt their own massive memory division just as much as they hurt Micron.
So it's mutually assured destruction, financially speaking.
It is. The result is a moderation of the supply side. We still have cycles, of course, but the depth and the duration of the troughs are likely to be shallower and shorter. And that implies a potential structural uplift in profitability across all future cycles, especially when you compare it to the historical bloodbath.
But let me play the devil's advocate here for a second. We saw Samsung make aggressive moves in the NAND market just last year, didn't we? They prioritized volume over price, and it hurt the entire industry. Doesn't that suggest this Nash equilibrium is, a bit fragile? Especially when they can just subsidize their memory losses with cash flow from their phones and TVs.
That's a very fair challenge, and it highlights why this thesis isn't guaranteed. Samsung's scale absolutely allows them to be the aggressor. However, the cost of an oversupply in the more capital-intensive DRAM market is far, far greater. So while Samsung might try to flex its muscle in NAND, the consensus among analysts is that in the high-stakes DRAM and especially the HBM market, the cost of oversupply is too high even for them.
And we saw proof of this recently.
We did. The 2023 wafer start cuts by all three players prove they are capable of rational collective self-correction when faced with an existential inventory glut. That was a huge signal.
Okay, so moving beyond the structural moat of capital costs, the AI era has created a specialized moat. It's active right now, high bandwidth memory, or HBM3E. This is the new currency for AI infrastructure.
HBM is not just a faster version of traditional DRAM, it's a completely different architecture. Imagine stacking 10 standard DRAM chips vertically. That is the physical reality of HBM.
10 chips high.
And these vertical stacks are interconnected using these incredibly fine paths called through-silicon vias, or TSVs. These TSVs allow for massive parallel data transfer, which is exactly what a GPU needs to feed its thousands of cores instantly.
And this is why the technical barrier is so high.
It is. Manufacturing HBM chips and then the subsequent stacking process is one of the hardest things done in all of semiconductor manufacturing today. It requires incredible alignment precision, specialized equipment, and extremely high yields to be cost-effective.
And that manufacturing difficulty is where Micron's current competitive advantage comes from.
That's right. Their current HBM3E chips are demonstrating a specialized moat because they are reportedly 30% more power efficient than their competitors' equivalent products at a comparable bandwidth.
30% more power efficient. Let's really dig into why that matters so much to a customer like NVIDIA or Microsoft or Meta.
It's simple economics on a massive scale. Data center power budgets are the largest constraint on AI build-out after the cost of the GPU itself.
So we're talking about electricity bills.
We're talking about massive electricity bills. When you are operating hyperscale data centers, think millions of square feet reducing energy consumption by even single-digit percentages is worth billions in operational savings over the life of the facility.
So that efficiency, that 30% number, it grants Micron very real and very substantial pricing power in this high-end segment.
Absolutely. In the AI arms race, performance per watt is often more critical than raw capacity. When you are the only supplier who can reliably provide the most power-efficient product that meets the GPU maker's specs, you are no longer a commodity seller.
You become a strategic partner.
An indispensable partner, and you can dictate terms.
Furthermore, the moat trajectory looks favorable because this technical bar just keeps getting raised.
It does. The increased technical complexity, especially that need for incredibly precise vertical stacking and TSV creation, it slows the pace at which competitors can catch up. This is especially true for those subject to U.S. sanctions, like YMTC in China. The intellectual property and precision engineering required are just extremely high.
So every new generation, HBM4, HBM5, it requires solving yet another manufacturing breakthrough, which just widens the moat for the leaders.
Precisely. Let's zoom out a bit and analyze the competitive landscape within the big three. This is a constant, high-stakes arms race with very defined player strategies.
You have Samsung, the 800-pound gorilla of the entire electronics world.
Their core strategy is volume and scale leadership. They can use their massive cash flows from other segments' display panels, consumer electronics, their foundry services, to subsidize memory investments, or they can even weather price wars longer than anyone else. They are the market brute force, and they've recently focused heavily on process simplification to scale HBM quickly.
Then you have SK Hynix.
SK Hynix. They've often been the technical aggressor, and you have to give them credit for their foresight. They established early HBM leadership through a strategic partnership with NVIDIA back in the Gen 2 and Gen 3 HBM era. That secured their position as the go-to specialist. Their strategy is often to be the first mover on premium high-margin technology, essentially challenging the whole notion that memory must be a commodity.
So where's that leave Micron? They aren't the largest, like Samsung. They weren't the earliest on HBM, like SK Hynix. Micron's unique edge, it seems to boil down to two factors: that performance per watt efficiency, which we covered, and geopolitics.
The geopolitical edge is now a tangible, bankable asset. It's huge. Micron is the most American of the three memory suppliers. They operate massive facilities in the U.S., and their supply chain is perceived as the most secure from a U.S. government perspective.
And that status makes them the preferred vendor for U.S. secure supply chains, for government contracts, for defense applications.
This isn't just about patriotism, it's about the THPS Act.
Right.
Micron is a major beneficiary, which helps offset those massive Capex costs we talked about. It also puts them in a strong position when dealing with key U.S.-based AI customers, the tech giants, who are increasingly prioritizing supply chain resilience and diversification away from South Korea and Taiwan due to regional stability concerns.
So being a U.S. champion is a crucial, high-value component of their competitive structure today.
It really is. Now let's step outside the financial models for a moment and perform a quick Skuttlebutt simulation. It's a check on how customers and employees actually perceive the company. This qualitative check often reveals some hidden operational truths.
Okay, and here we have to contrast two very different customer segments. On the enterprise side, where they're selling their cutting-edge HBM, DDR5, and high-end SSDs to corporations and data centers, Micron is viewed as a critical Tier 1 strategic partner.
For sure. Reliability, scale, and technical specification are just indispensable to these large clients, and Micron delivers.
But then you look at the consumer segment, primarily through their crucial brand.
Right, and the sentiment there is far more pragmatic. It's tolerated, not celebrated.
That's a great way to put it.
The products are seen as reliable commodities. They're characterized by good value for money, but they rarely inspire the kind of passionate brand loyalty you see in other consumer component segments.
You buy Crucial because it works, and it's priced competitively, not because you aspire to own the brand.
Exactly. And that pragmatism, it really mirrors the internal employee reality based on the available data. There is a hard-driving engineering culture.
And while compensation is often high, and the stability relative to the market is appreciated, especially at their headquarters in Boise, Idaho, the intense cyclical pressure is always there.
Always. Employees are acutely aware of the cycle. Layoffs hit hard during the troughs, and there is intense crunch time during the booms when everyone is rushing to meet sudden massive demand.
That volatility creates what analysts often describe as a mercenary culture rather than a missionary one.
Right. People are there for the incredible technical challenge and the compensation, but the loyalty is often transactional because everyone knows the cycle dictates their job security, regardless of how well they perform as an individual.
It must feel like constantly packing your office boxes every 2 years. That's a critical psychological input. It means retaining top talent long-term requires aggressive financial incentives, which just reinforces the cost-intensive nature of the business.
And that discussion takes us naturally into Pillar 2. Management stewardship and financial resilience. Because in a business defined by unavoidable capital intensity and volatility, management's ability to navigate the cycles and deploy capital rationally is the single most important determinant of long-term investment success.
Right. So let's pivot from the technology to the people running the show. Let's look at the leadership philosophy of Sanjay Mehrotra. He's been CEO since 2017, and he came over as a co-founder of SanDisk. So he's a veteran operator. And his mandate has been nothing less than transforming Micron from a volume-focused commodity pusher into a high-value solutions provider.
His core philosophy is centered on achieving cross-cycle profitability. Now, this sounds simple, but it is a massive undertaking in the memory sector.
It's the holy grail, really.
It is. Historically, the goal for memory companies was just to maximize volume, pray for a peak, and try to survive the trough. Mehrotra is aiming for a business that generates positive economic returns throughout the entire cycle. And that's a feat that requires incredible capital discipline and a willingness to sacrifice short-term market share for long-term pricing power.
And we can actually see the discipline reflected in their capital allocation track record. It shows a significant shift from prior management regimes. For instance, instituting a quarterly dividend, which they started, is highly unusual for a memory company.
Very unusual. It signals management's confidence in long-term sustained cash generation, even if the free cash flow is erratic from quarter to quarter.
Even more rational and very value-focused was their approach to share buybacks.
This is key. They performed aggressive share reduction during market downturns when the stock was cheap and earnings were depressed, rather than during the peaks when the stock was expensive.
That is textbook, countercyclical, value-focused management behavior.
Absolutely. They bought back shares when they were priced for death, not for glory.
However, we have to emphasize the unavoidable constraint here. Despite this disciplined approach, Micron is inherently what you'd call a capital hog. It's the antithesis to a capital-light software business.
The numbers are stark. Capex, the money needed just to maintain competitive standing, to move to the next technical node, to build the necessary HBM capacity, It consumes 30 to 40% of their revenue
30 to 40%.
every single year, regardless of the cycle. This isn't optional spending, it's the cost of existence.
And this massive reinvestment requirement, it severely limits their potential for share reduction, their cannibal potential, especially when you compare them to software peers.
They simply don't have the free cash flow left over to aggressively reduce the share count when they have to spend billions on next-gen equipment like EUV lithography.
Can you put some numbers to that, Capex? What does that equipment actually cost?
A single cutting-edge extreme ultraviolet lithography machine, an EUV machine, which is essential for manufacturing the smallest, densest memory chips, like the latest 1-gamma nodes. A single one of those costs anywhere from $150 to $200 million per machine.
Per machine. And they don't buy one.
They buy a fleet of them. This is a continuous multi-billion-dollar investment just to keep them in the race against Samsung and SK Hynix. It's what prevents them from ever becoming a true free cash flow compounding machine.
The ultimate proof of this management discipline, though, came during the brutal 2023 downturn. The industry was just drowning in inventory, prices were collapsing, and Micron's management, they passed the rationality test. They aggressively cut wafer starts, actual chip production, by more than 25%.
That was painful in the short term. It absolutely was. But it prioritized long-term value preservation over protecting short-term market share. It was a massive signal to the market that the big three are indeed acting rationally within that Nash equilibrium framework.
Right. They showed they could collectively self-correct supply, preventing a total price freefall, which is a huge structural change from the 1990s.
It's a different game now. So, given all that volatility, how do we assess the financial quality? Let's turn to the financial fortress, a qualitative view of their balance sheet and performance. And we have to stress again, profitability in this business is highly volatile.
You just can't judge Micron on quarter-to-quarter consistency. That's a fool's errand.
It really is. Consistency for this type of business is defined as consistently surviving the troughs, so you can be there to print massive money in the peaks. The focus has to be on cross-cycle average performance.
Let's look at the key quality ratio then. Return on invested capital, or ROIC. This measures how effectively management is using its capital.
Across the cycle, Micron manages to average around 13% ROIC.
Which crucially beats their estimated cost of capital.
It does. That suggests they are value additive over the long term, but the swings are seismic, and that's what defines the financial narrative.
Right, we've seen ROIC plunge to negative 5%, or even worse to the deepest troughs. Think about the 2019 or 2023 downturns. That's caused by massive oversupply and then subsequent write-downs of inventory value.
And conversely, that ROIC explodes to 25% plus at the peak of the cycle, which we saw during the massive PC and enterprise server booms of 2021. This volatility means any standard static valuation metric is basically useless.
So how do you underwrite it?
You have to underwrite the business based on the average through the cycle. You have to calculate what they earn when the music stops and what they earn when the music is loudest.
And this inherent capital intensity and volatility, it leads to poor free cash flow conversion.
It does. Even when they report massive net income at the peak, their FCF conversion, how much of that net income translates into usable cash for shareholders, is poor.
And why is it poor? It goes back to that capital hog constraint.
Exactly. For every dollar of net income they earn at the peak, a significant portion must immediately go back into the business. New EUV equipment, new fabs, R&D, it's all just to maintain their competitive position in the nanometer race.
So they're not throwing off buckets of truly free cash flow like a capital-light sauce company. They're always reinvesting for survival.
That's precisely why the balance sheet strength is not a luxury. It is an essential survival mechanism. Micron must run with a pristine balance sheet.
And they do. They frequently operate with negative net debt to EBITDA, which means they have more cash in short-term investments than total debt.
This massive liquidity buffer is the equivalent of an emergency bunker stocked with provisions. It is absolutely essential to survive those 12 to 18-month industry troughs when they are often losing money, but still must continue their Capex schedule to prepare for the next peak.
Right. Without that financial fortress, a downturn would force them to raise expensive equity at depressed prices, massively diluting long-term shareholders, which is the ultimate sin of a cyclical business.
In essence, the balance sheet stability is what allows the managerial discipline to flourish. They can afford to cut wafer starts and prioritize long-term pricing because they aren't desperate for immediate cash flow.
Okay, that makes sense. Which now transitions us to the core problem for the modern investor: valuation, risks, and catalysts. We have to translate all this structural analysis and operational volatility into a clear verdict on investment viability at current prices.
Right. So what does this strong yet volatile picture translate into for the stock price? Micron is historically a cyclical value stock. When times are good, when they're printing those 25% ROIC numbers, the market prices the stock cheaply, typically 8 to 12 times peak PE because everyone correctly anticipates the inevitable bust is just around the corner.
But right now, it carries a significant AI premium. It's trading closer to its historical book value highs, which signals that the market is pricing in sustained high-margin growth. It's essentially ignoring the cyclical element almost entirely.
And this is why the central tension is so acute right now.
For a stock like this, trying to use a discounted cash flow model, a DCF, is borderline nonsensical.
It is. The cash flow is just too erratic and dependent on the timing of capital expenditure. For a cyclical, capital-intensive business, the margin of safety is best found not in complex projections, but in the stable asset base. And you measure that by the price-to-book ratio, or PB.
The historical guide here is crystal clear. It provides the roadmap for patient investors. Buying Micron near 1 to 1.2 times price to book when the stock felt most distressed and the news was darkest, that has historically generated massive multi-bagger returns.
That's where the market was fully discounting the risk. It was pricing the company below its replacement cost.
But the current reality is dangerous.
It is. Buying at current levels, which are well over 2 times price to book, relies entirely on the supercycle thesis being correct. It offers zero margin of safety against a standard cyclical downturn.
So if the cycle reasserts itself, the price doesn't just dip, it immediately adjusts back toward that historical trough PB level.
Immediately. This highlights the final, crucial hurdle. Entry price dictates the return entirely. Paying peak cycle prices, say $150 or more during this period of maximum optimism, means the investor might wait 5 years just to break even.
Even if the underlying company performs well and eventually hits a new peak, your capital is just locked up during that necessary digestion period. It's a time arbitrage, not a value investment.
Exactly. But despite the valuation concerns, the primary growth engine is real and powerful: AI data center demand. The shift to generative AI requires vast, insatiable pools of HBM and DDR5 memory. This transition is expected to fuel memory demand for years.
However, we must address 2 critical permanent impairment risks. The first is sovereign risk, particularly concerning China. China accounts for a double-digit percentage of Micron's revenue. They are a critical end market.
And a total retaliatory ban by the Chinese government, maybe in response to escalating U.S. technology sanctions, would permanently impair Micron's earnings power.
This isn't a cyclical downturn. This is a structural market shrinkage.
That geopolitical risk has to be factored into the risk premium you assign to the stock, especially given the current U.S.-China tensions over technology supremacy.
The second major risk is technological disruption to the volume thesis itself. Micron's long-term prosperity relies on the assumption of continuous compounding memory demand. The risk lies in a new memory architecture, specifically something called CXL pooling.
Let's simplify CXL, which is Compute Express Link. Right now, memory, DRAM, is directly attached to the CPU or GPU. It's localized. CXL is a new high-speed industry standard that allows memory to be shared and pooled across multiple servers or even racks of equipment.
So instead of every server having its own dedicated RAM, you'd have a massive shared pool of RAM that any CPU in the data center can access quickly.
Precisely. And if CXL pooling becomes dominant, it could significantly reduce the total physical amount of DRAM needed.
Because you'd use it more efficiently, sharing idle capacity.
Right. And that fundamentally breaks the core assumption that memory demand is infinitely compounding on a per-chip basis. It's a real long-term threat.
But innovation also breeds catalysts. There are major events on the horizon that could accelerate the stock's re-rating beyond just the general AI boom.
The biggest one is the HBM4 launch, which is expected around 2026. This next generation promises another huge leap in bandwidth and efficiency. If Micron successfully captures significantly more than its current market share, let's say over 25% of this next-gen HBM market, it shifts market perception dramatically.
How so?
They would move from being one of the big 3 commodity players to being a specialized technical leader, an indispensable AI infrastructure component provider.
That specialization could lead to a permanent, major re-rating. It would grant them a higher sustainable multiple, moving them closer to the valuation of a specialized equipment maker.
And finally, a financial catalyst. capital returns. Assuming the current cycle continues to peak and generate substantial free cash flow, resuming aggressive counter-cyclical share buybacks once cash flow stabilizes post-HBM ramp-up would signal immense management confidence.
Confidence in their long-term stability and discipline.
Yes, and that use of capital would provide a substantial boost to per-share metrics, rewarding patient shareholders.
Okay, now we move to Pillar 4. Final synthesis and the red team challenge. We have to bring together this debate between structural change and historical volatility to form a concluding view.
Let's start with the standard market thesis, the consensus view. It's simple and it's seductive. AI is a multi-year, multi-decade tailwind. Buy Micron because NVIDIA needs them, HBM provides temporary pricing power, and memory demand will never stop growing.
Simple enough. So what's the contrarian view, the necessary second-level challenge?
It's much more nuanced and grounded in history. The AI build-out is absolutely real and fantastic for demand, but memory is still fundamentally a commodity at scale. This introduces the critical supply response risk.
The classic cyclical fear that the market is currently ignoring.
That's it. Samsung is the 800-pound gorilla with near-limitless capital. If, or more likely when, Samsung manages to fix its HBM yields, which have been challenging but they are improving, they will aggressively flood the market with high-quality HBM supply, probably in 2026.
And this would crush prices for HBM just as Micron is ramping up its own expensive HBM capacity.
It would immediately render Micron's current 30% power efficiency pricing power temporary and erase the AI premium.
It's the classic dynamic where the cure for high prices is high prices, leading to massive capital investment and eventually oversupply.
The exuberance today is pricing in a multi-year lead that may only last 18 months.
Okay, let's summarize the investment thesis in a quick one-pager format, just to outline the tension for the listener.
Good idea. The bull case. The reasons to own this stock at any price rests on three main pillars. First, oligopoly power. The industry is disciplined, and the Big Three structure protects long-term margins by avoiding self-destructive pricing wars, which was proving by the 2023 Capex cuts.
Second, the AI supercycle. HBM is a high-margin, specialized product with massive demand, currently providing Micron with unique, temporary structural pricing power due to its power efficiency leadership.
And third, U.S. champion status. They are geopolitically indispensable as the only Western memory fab. That makes them a safe harbor choice for U.S.-aligned companies and a beneficiary of CHIPS Act funding.
Okay, that's the bull case. Now the bear case, the necessary counterthesis, also resting on three pillars. First, capital intensity. The business is a perpetual cash burner. The need to constantly reinvest 30 to 40% of revenue just to stay competitive makes free cash flow inherently erratic, and it severely limits true shareholder returns compared to capital-light peers.
Second, the cyclical trap. The current valuation, well above 2 times price to book, suggests we are operating closer to the peak of the cycle than the trough. This means the margin of safety for new entrants at current prices is non-existent, and a standard cyclical pullback would be brutal.
And third, the Samsung risk. Eventual HBM commoditization will happen. Once Samsung solves its yield issues and floods the market with volume, the pricing power Micron enjoys today will erode, erasing the lucrative AI premium and driving the stock back toward a cyclical multiple.
And this brings us to the red team challenge, the most provocative inversion of the bull case, the Icarus trap.
The Icarus trap. Tell me more.
The investor today is essentially buying a capital-intensive commodity business, one that requires continuous existential reinvestment.
Right. Tough business.
But they're buying it at a valuation multiple that's historically been reserved only for capital-light, asset-generating software compounders.
So you are betting that this time is profoundly, fundamentally different.
You're betting that memory will no longer be cyclical, and that Micron can maintain this high-margin specialization against Samsung's overwhelming scale advantage. That is a massive assumption that historical analysis suggests is dangerously optimistic.
So let's define the downside scenario. What does that look like?
If the AI demand build-out just pauses for even 2 quarters, not a crash, but just a brief digestion period, allowing the market to absorb the chips already shipped,
Wow.
Micron's temporary HBM pricing power will collapse instantly. Inventory will spike, and the stock could easily draw down 50% from current high levels, erasing all of the AI premium in a matter of weeks.
Wow.
It's the old market analogy about picking up nickels in front of a steamroller. The difference now is that the steamroller just got a massive turbocharger called AI, making the potential collapse even faster and more brutal when the inevitable cyclical gravity reasserts itself. You're taking enormous valuation risk based on a structural shift that is yet to be proven permanent.
That structural tension, the undisputed quality of Micron's improved competitive structure and HBM efficiency versus the unavoidable cyclicality and the dangerous current valuation, that is what makes Micron such a compelling and potentially dangerous investment right now.
Exactly. The core investment question isn't if the AI growth is real. The demand signals are undeniable. The question for the long-term investor is when the industry's rationalized but still potent capital response catches up to the demand, and whether the company's discipline can truly overcome the sheer volume and scale advantages that Samsung and SK Hynix can deploy when they finally perfect their HBM yields. That is a fundamental risk you are taking at today's elevated valuation levels.
Powerful conclusion. That gives us a tremendous amount to think about, particularly regarding the risk profile at current prices versus the long-term structural tailwind. Thank you for joining us on this deep dive into Micron technology.
And for you, the listener, think about this. The technology is fantastic, the demand is real, but memory remains a physical product defined by massive capital investment. Does any single company, even with a temporary efficiency lead, have enough pricing power to justify a software multiple in a factory-based business? That is the real question to mull over.
Excellent final thought. Let us know what you think in the comments section. Are we in a true permanent supercycle, or is the old order of volatility still supreme? We will see you on the next deep dive.